Earnings season is underway, and estimates for the quarter little bleak, although some companies that have reported have beat estimates. According to FactSet, S&P earnings growth rate is estimated to be around 2.4%. That's down from 9.2% estimates in September.
And while the overall outlook is dim, for some sectors, it's even dimmer. Here with three sectors you have to avoid this earnings season is Jeff Reeves. He is the editor of InvestorPlace.com. And we got to put in a proviso that you may be wrong, so maybe these sectors will take off, but this is your feeling. Now, healthcare is one of those sectors you say we should watch out for. I would have thought that with all the Obamacare mandates that some of these earnings are locked in, that they would do well, but you say no way.
Yeah, and to be clear, I mean, we're talking about the direction for the analyst estimates. That's not to say that some of these companies aren't still going to grow, but they're going to grow less than some expected. In one particular area,
if the Obamacare mandates are locked in, why would healthcare as a sector do poorly?
Well, in regards to the Affordable Care Act, I mean, one specific area that I'm watching is pharmaceuticals that are seeing a little bit of a hit. I mean, Teva Pharmaceuticals is a big generic company. It's moved down its estimates, or analysts have moved down its estimates because there's fear that it's an easy target to kind of put a cap on prescription drug costs. And if Teva can't command a higher price for its products, then it's naturally going to see less money. So, I mean, there's that element
Jeff,
of it.
Let me just push you on this. More volume if we're adding millions of people to the insurance rolls, and they will need the Lipitors or the generic Lipitors. Why will that not then cover what they lose in margins, perhaps?
Well, I mean, Lipitor is a pretty good example because, I mean, Pfizer has actually seen a lot of pressure since Q3, since it's gone off patent. I mean, there's a lot of complex issues here.
Right.
But, I mean, the bottom line is that a lot of these companies can't sell product for the margins that they used to. It's granted there's going to be more consumers in the pipeline eventually. But keep in mind, we're talking about Q4 estimates right now where a lot of this affordable care stuff hasn't really come into effect in full force yet. So, I mean, I'm watching pharmaceuticals because I think that the whole cap on prescription drugs is an easy target. And, I mean, Teva kind of shows that. This is, again, Wall Street estimates in general, not just my opinion, have been moving back because of some of this. So there's a little bit of pressure in pharmaceuticals in general.
So your first sector is healthcare to avoid. Your second is materials. Now, obviously, a lot of this is driven by perhaps demand in China for growth. We've started to see China stabilize and maybe even come back a bit. Why don't you like materials?
Well, yeah, and again, this is kind of the nature of earnings season is that we're inherently in a rearview mirror right here. We're talking about Q4, which is from September to December. So there has been a little bit of recovery in pricing for some commodities out there, like copper and iron that goes into steel. China has seen some optimism lately. But again, if you're looking at the Q3 numbers for some of these companies, there's been a rollback in some of the estimates for these material stocks, particularly in copper, aluminum, iron, just because the forecasts have moved down. I mean, as we've seen with Alcoa actually beat its numbers, but the forecast was pretty darn low. So, you know, we're talking directionally here. The bars are moving lower for all these companies. It's not to say they won't step across it based on some optimism, but generally speaking, directionally, the pressure is down.
All right. Information technology, the tech sector in general. Of course, a lot of people have seen that because the PC is losing ground because of all the iPads and the other tablets, that sector is moving down. We've seen what's happened to Apple. What else do you see coming with the IT sector?
Yeah, I mean, I think a lot of people have kind of, they hope for this secular recovery in kind of IT spending, that there's going to be an upgrade cycle for businesses. Hasn't really happened. You've seen a lot of pressure on estimates for Intel and AMD, the semiconductor companies, Hewlett-Packard and Dell. The story is the same there, but it's also the consumer side with tablets. I mean, as we've seen, there just isn't as much demand there as there used to be. PC sales were down for the first time in 5 years over this holiday season. So estimates are moving down to reflect that, as both the consumer and the business side. And, of course, Apple's estimates have moved down too, which is kind of a big anchor.
I was going to ask you about Apple. I'm just interested in your opinion. Where do you think it goes from here?
I mean, personally, I'm long-term bullish on the stock. I mean, if you look at, again, you're looking at the smart money out there, analysts are predicting a price target, the median target among 49 people out there is $730. That's 35% upside from here. Even if that all doesn't happen, it's still a significant gap. And I would caution people, if you take the EPS game, you know, for 2014 and you say, oh, well, you know, the valuation isn't super attractive at single digits because the earnings estimates are going to go down. Even if you say that Apple is going to make less money in 2012 or in 2013 than it does in 2012, then it still has a current PE of about 14, which is fairly valued. If it only makes $35 instead of $56 in fiscal 2014, it's a current PE of 14. That's attractive historically for Apple. Not to say for the entire S&P 500 is pretty attractive. So
right.
I would caution people not to play that game where they worry about Apple falling off a cliff because estimates are going to fall fall off a cliff too. Even if it does that, it's going to be fairly valued.
Still a lot of smart people there making great things. Thanks, Jeff. Good to see you.
Thank you, Jeff.
Yep, good to see you too.
Well,